Hello, good afternoon, and welcome to Carr and Ingram's Year-End Tax Planning. In this webinar, we are going to focus on tax planning ideas for businesses. For those businesses looking forward to 2021, you may be thinking about what year-end activities you need to undertake to optimize your tax benefits. And you may also be curious about what law changes may have occurred that may make this different than years past. On this webinar today, we'll kind of cover some of those topics, give you some ideas to start thinking about, and maybe reach out to your CRI advisor and start a conversation. Before we get too far into it, I did want to cover the CPE certification requirements. I know some of you will be looking for CPE credit here, so if you do need CPE credit, you will need your own unique registration link. You'll have to stay logged in during the webinar for at least 50 minutes and answer at least 80% of the polling questions. If you meet those requirements, you should receive your CPE certificate within 7 days after the webinar. If you don't receive that certificate after 7 days, feel free to email our marketing team at the email address here. Also, for those interested in getting a slide deck for what we'll be covering today, you can go into the handouts section of the GoToWebinar platform and download those slides now so you can have your own copy handy. Also, everyone who registered for today's webinar will receive a recording of this webinar as well as the PDF of the slides about 24 hours or sometime tomorrow. You'll receive that in email. Everyone will be in listen-only mode for the duration of the webinar. So if you do have any questions, we ask that you type those into the questions section of the GoToWebinar platform. We will try to get through as many questions as we can. And this morning we had a individual tax update, and we weren't able to get to all the great questions that were coming in. But I would encourage you to go ahead and get those in. If you have them, we'll try and tackle as many as we can. So now I'm going to go through and make introductions of our presenters today. I'm going to start out with myself. My name is Chris Hoffman. I am a partner in the Nashville, Tennessee practice office. I'm also the tax service line leader of the firm. I've got my master's degree from the University of Tennessee, and I enjoy watching my volunteers as well as the Tennessee Titans and the Nashville Predators. We do make an annual trip every year to Hilton Head, South Carolina as a family. We enjoy the beach down there. And we do have 2 Boston Terriers at home that keep us busy as well. Also presenting today will be Cindy Bryan. She is a partner in our Southwest SPU practice unit. She's been experienced in public accounting and has been working in public accounting since 1988. Interesting fact about Cindy is she has won a cooking contest using Spam. She likes traveling. She goes to livestock shows and also likes all sorts of animals such as cats, dogs, chickens, horses, pigs, goats, and you name it. Lastly, Kellie Shipley is a partner in our Corpus Christi office. She's also the partner in charge down in Corpus Christi. She has her master's degree from the other UT, University of Texas. She enjoys watching the Pittsburgh Steelers. In her free time, she practices being a chauffeur by taking her kids around to practices and games. And she also has 2 dogs at home. So in terms of the agenda today, things we're going to cover, we're going to start out with the CARES Act. It is one of the coronavirus pieces of legislation that Congress passed earlier this spring. We're going to also cover the qualified business income or QBI deduction. It's still relatively new that we still want to cover that and make sure that we are optimizing that deduction. We're going to cover entity selection and depreciation. Always popular topics, especially given some of the recent law changes over the last few years. We'll also cover a PPP, or Paycheck Protection Program, give you an update on that, as that has been a very hot topic in 2020. We'll also cover retirement plans and what businesses may want to consider in terms of different options there. We'll wrap up with the 2020 election and cover what we think may be forthcoming after the election. And then, as I mentioned before, if there's time permitting, we will cover questions. So with that, we will pass it off. I will hand it off to Kellie, who will start off in the CARES Act.
Thanks, Chris, and good afternoon, everybody. So I'm going to start with an overview of the CARES Act, which is the first topic that we're going to cover today. So it's been quite a year, let alone quite a week this past week. We've had the election, the pandemic, multiple rounds of stimulus packages and nationwide closures. It's really changed the way that we currently do business. Only 3 years ago, we were just beginning a conversation about major tax reform, and now many of those historical tax changes have either been rolled back or deferred in an effort to help taxpayers survive the pandemic and the resulting economic collapse. So as Chris mentioned, on March 27th, President Donald Trump signed the Coronavirus Aid, Relief, and Economic Security Act, also known as the CARES Act. This was the third phase of legislation aimed at fighting the pandemic and trying to help out families, workers, and businesses. So some of the tax-related CARES Act provisions that we're going to cover today include the modification of the NOL, the modification of the deduction limitation on business interest, a qualified improvement property technical correction, and payroll tax credits and deferrals. So I'm going to jump on in and start talking about net operating losses. The CARES Act presents some one-time opportunities for taxpayers to reduce their taxes and obtain refunds from prior years. Following the passage of the law known as the Tax Cuts and Jobs Act, which is also known as TCJA, net operating losses generating in tax years beginning in 2018 and later could not be carried back, and they could only offset up to 80% of taxable income in the carryover years. So what the CARES Act did is it changed that, and it permits NOLs from 2018, 2019, and 2020 to be carried back to the previous 5 tax years. It also suspended the 80% of taxable income limitation through the 2020 tax year. So if your business has a taxable loss in 2020, some careful analysis is needed to see if you can maximize the tax benefit of this loss, since it can be carried back 5 years. So losses incurred in 2021 will no longer be eligible. So this tax year is your last chance to recover tax payments made in 2015 through 2019. Aside from the cash flow benefits, NOL carrybacks also present an opportunity to secure permanent tax savings by using losses to offset income generated prior to the TCJA when the tax rates were higher. So for example, say you have a corporate NOL from 2020, this can be carried back to offset income from 2015 that may have been subject to a 35% tax rate, rather than carried over to 2021 when the income is subject to a 21% tax rate. Next, I'm going to discuss limits on losses. So the TCJA created a new limitation on the ability to utilize pass-through losses on individual returns. The provision limited an individual taxpayer to the deduction of no more than $250,000 of business loss for a year, or $500,000 for taxpayers filing jointly. Any excess business loss incurred during a year is carried over to the following tax year. This limitation was originally effective for the 2018 tax year, but the CARES Act amended this, so it's not effective until 2021 now. So a little planning, if there's, to the extent that you have some flexibility to time your losses or expenditures, it's an idea to incur them in 2020 rather than delaying to 2021 when the limitation is scheduled to take effect. All right, next I'm going to go over business interest expense. So before the CARES Act, under the TCJA, a taxpayer could deduct business interest only up to 30% of the taxpayer's adjusted taxable income. For 2019 and 2020, the CARES Act increases this limitation amount to 50% from 30% of the taxpayer's adjusted taxable income for 2019 and 2020. So what exactly is adjusted taxable income? It's really similar to earnings before interest, depreciation, and amortization. And it's calculated by taking taxable income and taking out items of income or loss that are not allocable to a trade or business, adding back any NOLs or 199A deductions, taking out any business interest expense, and adding back depreciation, depletion, and amortization. Also, as part of the CARES Act, taxpayers can elect to use their 2019 income in place of their 2020 income for this computation. So for a lot of taxpayers, this could allow for a higher interest deduction in 2020. Taxpayers can also elect out of each of these changes, and any interest expense that is limited does carry forward indefinitely. Now, there are some exceptions to the taxpayers who are subject to this interest expense limitation, and these include small taxpayers, which is if you have generally less than 26 million of gross receipts, taxpayers with interest related to floor plan financing, and electing real property trades or businesses. So for businesses that have floor plan financing or are electing real property businesses, the trade-off for not being subject to this interest expense limitation is that they have to use a longer depreciable life under the ADS, alternative depreciation system for real property assets. And on top of that, these ADS, under ADS, these assets are not eligible for bonus depreciation. So if you did have a business interest expense limitation, you do have the option to amend your 2019 return to take advantage of this increased limit. Also, on your 2019 return, if you were an electing real property trade or business or had floor plan financing, and you also placed qualified improvement property into place in service in 2018 or 19, you can amend your tax returns to revoke that election and possibly subject yourself to the business interest expense limitation in order to take that bonus. So a good analysis is needed to if the limitation is better or the expanded bonus depreciation is better. And that's something that your tax professional can help you with. Also, I did want to mention that the Internal Revenue Service in late July finalized rules on the original 30% limit. The final rules were 575 pages long, but I'm just going to touch on a couple of the main points. The final rules did explain that debt issuance cost and commitment fees are excluded from the definition of interest. So that's good that they clarified that. Also, the business interest deduction limits, they're applied at the partnership level. So the partnership determines the limitation allowable business interest deduction, and then it allocates the permitted interest among its partners. So any business expense that can't be deducted during a taxable year, it's called excess business interest. And so this EBI can be deducted by the partner only if the partnership allocates a partner's excess taxable income in a subsequent year. And that leads us to our first polling question.
Okay, thanks, Kelly. The first polling question covers the topic that Kelly just covered on our last slide, and that is, under the CARES Act in 2019 and 2020, business interest expense is deductible up to what percent of adjusted taxable income? Give everyone a few moments to respond, and while we do, Kelly, we had a question that came in on the NOL carryback. Question, someone was confused on how far back you can carry losses back. So can you cover the years where the NOL can be generated and how far back those NOLs can be carried back?
Sure. So the NOL can be carried back 5 years. So this is for tax years 2018, 2019, and 2020. So the earliest one that you can carry back is 2018, which could go back to 2013. So 5 years.
Yeah, perfect. Thank you. Let's go ahead and look at those poll results now. We have 70% of the audience saying that the limitation is now 50% of adjusted taxable income, while 18% is saying 30%, and the rest are the other two options. So it looks like we've got a lot of people paying attention here, because that is exactly what we're looking for, isn't it, Kelly?
Yes, that's right. 50% is the right answer. It was increased from 30 to 50.
Okay. And with that, I'll pass it off to Cindy, who is going to cover the CARES Act and the retail glitch that was fixed in there.
Good afternoon, everybody. Thank you for taking time to spend a little bit of your time in the afternoon with all of us. I want to talk a little bit about what has been coined the retail glitch. In the TCJA that Kelly defined earlier, Tax Cuts and Jobs Act, there was what's been coined a retail glitch. Prior to the TCJA, there were some classifications of real property that received some preferential treatment, meaning that they were able to enjoy a 15-year bonus depreciation or 15-year depreciation, and they could also use bonus depreciation in Section 179. When the TCJA came into effect, it effectively combined those classifications into something known as qualified improvement property, which is generally defined as improvements to the interior of a building that had already been placed in service, with a few exceptions. In the glitch in the CARES Act in the TCJA was that the property classes were no longer defined, and the qualified improvement property didn't define the depreciation as 15-year and eligible for bonus in Section 179. So it defaulted to non-residential commercial property with a 39-year recovery property period. Now, that takes a long time to depreciate a building, and anybody that's built one and financed it knows that their debt is for 10 or 15 years, and so your cash flow is not matching up with your debt. So that's why the TCJAs, or prior to the TCJA, that was such a popular provision. So what happened in the CARES Act is they completely fixed that retail glitch. Not only did they define that property as 15-year property, they retroed it back to December 31st, property placed in service after December 31st, 2017. So that's really exciting. And also what that's going to allow us to do is combine some of our tax planning with some of the other provisions of the CARES Act that Kelly was talking about, because there are a couple of ways to correct that glitch if you've already filed a 2018 or 2019 tax return that had qualifying property placed in service after December 31st of 2017, and you're taking depreciation over 39 years. You can amend those returns. There's also a provision in the law that allows for you to file what's called a Form 3115 and take all of that depreciation into 2020 and make, withdraw, or revoke any elections that you need to make. So when you're planning for carry back of the net operating losses or possibly carry forward, or what type of depreciation you want to take on this qualifying property, you have a lot of planning opportunities in that area based on the timing of and how you actually fix that return. So that it's really important that you talk with your tax advisor and you guys discuss what's the best way to correct that, but make sure that you do, because it's a really powerful provision that got corrected in the CARES Act. So that brings us to another polling question.
Okay, thanks, Cindy. Another polling question covers that QIP property that Cindy just mentioned. The CARES Act corrects the depreciable life of QIP from 39 years to what? Is it 10 years, 5 years, 15 years, or 25 years? Give everyone a few moments to respond. And in the meantime, Cindy, we had a question came in just wanting to clarify that would QIP also include leasehold improvements? Can you clarify that?
Yes, it includes property that's upgraded to any property improvements that are done to the interior of a building after the building was first placed in service. So it should cover those. Chris, is there something I'm missing on that?
No, I believe so. I believe that's right. Anything that would fit under the old qualified leasehold improvements would also definitely fit under the QIP definition as well.
Yes, I agree with that. So be sure you're looking into that as you're planning for your 2020 year end.
Absolutely. I will share the poll results now. And looks like we have a very attentive audience here. We have 90% of the audience selecting 15 years, 7% doing 25 years, and the rest doing 10 or 5. So that is actually exactly what we're hoping for there. And what Cindy covered is the CARES Act fixes that glitch from 39 years down to 15.
Congratulations, everyone. That's great. Thanks for tuning in.
Yep. And now I'm going to pass it back to Kelly, who's going to cover some payroll related items in the CARES Act.
Thanks, Chris. So I'm going to go over the CARES Act provisions related to payroll, which includes some tax credits and deferrals for employee and employer taxes. The CARES Act established 2 workplace credits that reward small businesses for protecting their employees against any of the pandemic-related setbacks. So the first is a paid leave credit, and this is a refund to employers up to 100% of the cost to provide sick or family leave to their employees. The second is the employee retention credit, and what this does is it refunds the employers 50% of the wages attributed to the employees that they were able to retain when there was an upset in normal business operations. So it really encouraged employers to keep on their workforce and keep paying them during the shutdown time. Both of these credits are only valid for payroll periods through the end of this year. So qualifying for these credits and understanding how they mesh with the other assistance programs can be tricky, but using them has allowed businesses a little extra cash as they head into the next year. Next is the employee deferral. So Trump signed a memorandum in August to defer the 6.2% of the employee's share of Social Security taxes from September 1st until December 31st of this year. But the catch is that these taxes need to be repaid by April 30th of next year. So because of that, relatively few companies have implemented this tax deferral since it needs to be repaid, but the federal government and the military are both implementing it. Recently, the IRS issued some guidance for reporting this deferral, where you have to issue a corrected W-2 form once these taxes are actually paid back in the next year. So it's a bit of an administrative burden, but it helped out the people that needed some cash during the end of this year. And the next is the employer deferral. So the employer share of the 6.2 Social Security tax on wages paid from March 27th of this year through the end of this year can be deferred. Instead of being paid in when it was due, instead the businesses could pay 50% on or by December 31st of 2021, and then the remaining 50% by December 31st, 2022. There's also a similar rule that applies to deferring 50% of self-employment tax liability of partners and sole proprietors. So we haven't really recommended that clients use this deferral unless they're truly absolutely cash strapped, because like the other one, it's a deferral, it's not going to be forgiven, and it does need to be paid back. And with that, that leads us into our next polling question.
Okay, thanks, Kelly. Next polling question covers that payroll tax deferral. The CARES Act allowed payroll employers a payroll tax deferral, but the payroll taxes have to be paid in. Is it 100% at the end of December 2021? Is it 50% at the end of 2021 and 50% at the end of 2022? Is it all at the end of December 2022, or is it just all forgiven, not deferred? And it says December 21st here, but yeah, I think it's meant to be December 31st, last day of the year. Quick question that, actually a couple questions that came in, Kelly, on this. If an employer received PPP funds, could they also receive a tax credit for the paid leave program?
You know, I know for the deferral, originally, if you got a PPP loan, you couldn't take it, but they repealed that in June. As for the credit, I believe it's the same situation. Is that what you're seeing, Chris?
Yeah, I believe if you get the PPP funds, you can't also do the tax credit for the paid leave, is my recall.
Right,
like I said,
so the only thing that they took back that you couldn't do was the employer deferral. So you can if you have a PPP for the deferral, but the tax credits you can't.
Right. Another question that came in is, what is being deferred? Is it just the employer's 2020 payroll taxes, or does the deferral last all the way through 2021 and 2022?
So it's just for the 2020 employers portion of the 6.2% of Social Security. So in the tax years 2021 and 2022, the payroll tax is going to be paid in as normal, and you're going to have to pay back what you deferred from 2020.
Okay, thanks, Kelly. Let's go ahead and look at those poll results. 55% of the audience said that it's 50% paid back at the end of 21, 50% at the end of 22. 37% said it all has to be paid back at the end of 2021. And the rest of the audience had the other two options. Looks like, Kelly, there may be a little bit of confusion on this. Can you clarify for us?
Sure. So the correct answer was 50% at the end of next year and the other 50% at the end of 2022. So it's a pretty long deferral that spans over 2 years from now.
Thanks, Kelly. And with that, we will now go ahead and hand it back to Cindy, who's going to cover qualified business income deductions.
Thank you, Chris. Yes, I'm excited that they asked me to talk about this particular deduction. It's been around since the Tax Cuts and Jobs Act, and I really like it because it's a deduction that if you qualify for it, you don't have to spend another dollar of cash to get it. And so what is it? If you're a sole proprietor, non-corporate owner of a pass-through entity like a partnership, S corporation, certain trusts, you can get a deduction of up to 20% of your qualified business income with certain limitations for W-2 income and W-2 expenses and qualifying property if they kick in. So I said, we sole proprietors, people that file their businesses along with their individual tax returns, non-corporate owners of pass-through entities, those are partnerships, S corps, certain trusts. They're eligible to take that deduction if their income is qualified. Now, some people can't take the deduction. C corporations, regular corporations that pay their own tax, they're not available to take that deduction. And you can have a limitation if you have a specified trade or business. And what the simple definition of what a specified trade or business is if the income comes from your own efforts. If you're an accountant, a lawyer, a doctor, it's primarily from your own personal efforts that your income comes. You've got to keep your income under $315,000 if you're married filing jointly, or $157,500 for all other filing types, in order to take advantage of the 20% deduction. And it phases out after a little bit. You can get portions of it up to about $400,000, somewhere around in there for the married filing jointly class. So planning becomes really important for people that have specified trade or businesses to try to keep that income down. So the depreciation that we talked about earlier, the retirement plans we're going to talk about later, those can be really important to help those people with specified trade or businesses still qualify for the qualified business income deduction. And then the IRS also implemented a safe harbor requirement for rental income. And you have to comply with some certain things in order to be able to take the qualified business income deduction on your rental income. You have to definitely keep separate books and records. You have to provide 250 hours of service to your rental business, and it has to be performed in at least 3 of the last 5 years. So what that means is you perform that service for your business 250 hours in year 1, 250 hours in year 4, 250 hours in year 5, or any combination of that. And you have to make sure you do that. And then you have to attach an affirmative statement to the return. Now, the 250 hours of service, you can get that through making sure you're advertising for your rental, making sure you're negotiating the leases, making sure you're collecting the rent, making sure you're taking care of the operations, like you're making sure everything's repaired and in good working order. And you're just generally managing that rental. And so if the safe harbor isn't met, then you must meet the trade or business requirement, which is a much more stringent requirement. So if you have rental property, or even if you're renting property from your corporation, you want to make sure that you're complying with these safe harbor requirements so you can get that qualified business income deduction if you're otherwise eligible for it on your rental property. And So with that, we'll have another polling question.
Okay, thanks, Cindy.
Mhm.
Next polling question covers that safe harbor that Cindy just mentioned. And that is, the rental income safe harbor requires how many hours of service in 3 out of the last 5 years? Is it 500 hours? Is it 100 hours? Is it 1,000 hours? Or is it 250 hours? So give everyone a few moments to respond to that polling question. And while you do, I do want to clarify and correct. I think during our last polling question, we were asked about which credits could be used with the Paycheck Protection Program. You can use the paid family leave credit and the emergency paid sick leave credit with the PPP, but you cannot use the employee retention credit with the PPP program. So in the tax credits that we were discussing in that last section, I think I may have misspoke when I said that you can't use some, that you can use 2 of the 3. You can use the paid family leave credit, the paid sick leave credit. You cannot use the employee retention credit with the Paycheck Protection Program. So just wanted to clarify that for everyone real quick. And with that, we'll go ahead and look at those poll results. Looks like 70% of the audience has responded that 250 hours are needed. 22% of the audience said 500 hours are needed, with the rest of the audience weighing in on the other 2 options. So it looks like the majority of people are on board with that, Cindy. I think that's the answer we were looking for.
Yes, sir. Yes, it was, Chris. That's the answer we're looking for, 250 hours to meet the safe harbor requirement.
Okay, great. And I think Cindy is going to continue on here with entity selection and depreciation.
Yes, entity selection is very important for several reasons. There are tax reasons for selecting a certain entity structure. There are also outcome reasons. There are also structure reasons. And so it's very important to talk with your tax advisor about these different types of entities. So we're going to talk about a few of them now. Corporations, they've been around a long time. They now are enjoying a 21% flat rate for right now. And the income is taxed inside of the corporation. So if the shareholders need to get money out of the corporation, it has to be paid out in dividends, which would be taxed at up to 23.8%, which would include the net investment tax for those higher income taxpayers. And it's not eligible for the Section 199A deduction. But there are some reasons to have regular traditional corporations. One of them is if you're in a high income tax state, and a pass-through entity is passing through. Pardon me?
Hey, Cindy, it looks like the slideshow has frozen up on us.
Oh, okay.
So let me do a quick refresh.
Okay.
And see if we can get back on board here so people can see the slides. There we go. I think we are back on board now.
We look like we're back.
Sorry about
now.
that.
Yeah. No, not a problem at all. So what we were talking about was one of the advantage of a corporation is they're not limited to the $10,000 limitation for the deduction of state income and property taxes. So if you're in a high income state, you need to talk to your tax advisor. A corporation may be something you want to look at. I also wanted to talk a little bit about partnerships. Partnerships are a really flexible form of entity when maybe a corporation isn't right and maybe an S corporation won't work because you need something like special allocations of income or expenses. You might have foreign partners. You might have more than 100 partners. Or you might have somebody that wants to invest in your company that's not a qualified S Corp owner. Maybe it's another corporation or another partnership or some form of entity like that that you need to invest. Then a regular partnership, a partnership or an LLC with partnership treatment may be a good option for you. One thing I wanted to kind of bring up for people that have been in partnerships for a number of years, the draft of the 2020 instructions are telling us that we're going to have to report the partner's capital on a income tax basis. Now, the good news is most of us are already reporting our partnerships using the income tax basis. But if you have a partnership that's reporting your capital on the generally accepted accounting principles, like you report on your financial statements, or some other hybrid type of form of capital reconciliation that you use for your business, you may need to look and work with your tax advisor to start thinking about getting to that tax basis capital. And then one very popular form of entity that a lot of people are using today are S corporations or LLCs that have elected to report as an S corporation. S corporations avoid the double taxation issue that you have with a C corporation, where the C corporation pays the tax and then you pay tax again on the dividends coming out. So you could have a fairly high tax rate that way. S corporations, they avoid that because the net income passes through to your individual tax return after you've taken a reasonable salary for your services to the S corporations. Also, the owners are eligible to take the Section 199A deduction on that income that's passing through from that S corporation if they're otherwise eligible for that deduction. And that's that qualified business income deduction we talked about a little bit earlier. S corporations, on the other hand, aren't quite as flexible as partnerships. You have to make proportionate distributions to your shareholders. You can't make special allocations towards one shareholder or another like you can with a partnership. You can only have one class of stock. You have to have less than 100 partners or shareholders, and only individuals in certain trusts can own the stock in an S corporation, but they're very popular. They're a very popular form of entity to help taxpayers do things like control the amount of FICA tax that they're paying by taking a salary from the corporation, because those pass-through revenue to your individual tax return is not subject to the self-employment tax. And then finally, the most simple form of entity, which is sometimes right for single member LLCs or just simple smaller businesses, are sole proprietors. Those are reported on your income tax return on Schedule C. It can be a single member LLC. You can take the Section 199A deduction. It allows you to take, if you're otherwise eligible, some deductions for your health insurance, some different things like that. But you are subject to self-employment tax on the total amount of net income of that sole proprietorship. But so those are the most popular forms of entities that businesses are using. And so if you have a question about your particular situation, you need to reach out to your CRI advisor and talk about which one of these may be the best for you in your situation. And with that, we'll have another polling question.
Okay, thanks, Cindy. Next polling question covers one of those entity types that Cindy just told us about. Partnerships. Beginning in 2020, partnerships are required to report the partner's capital accounts. Is it on the income tax basis, the generally accepted accounting principles, or GAAP basis? Is it old basis or new basis? Give everyone a few moments to reply to this polling question. And in the meantime, we have had some more questions come in. Cindy, you mentioned for the Section 199 Cap A, the specified service trade or business. There are a few questions that came in asking if you could cover what would be some examples of a specified service trade or business.
Sure, absolutely. Specified trader businesses, again, I said the most simple explanation of what one is if your revenue comes from, the bulk of it comes from your own services, and some businesses do combine. So examples of businesses that derive most of their revenue from their principal owners' personal efforts are businesses like accounting services, lawyers, physicians, some consultants. Now, if you're an architect, you want to look at that very carefully because there are some special rules out there for architects because of their close association with the construction industry. But generally, if you're any kind of consultant or you're a lawyer, accountant, attorney, some kind of profession, a physician, where your revenues derived from your own efforts, you want to talk to your CRI advisor about, is my business a specified business, and what can we do to manage the income of my specified business so I can qualify for that qualified business income deduction or the Section 199A deduction.
Okay. Thanks, Cindy. Now,
Thank
quickly
you.
look at the poll questions, or sorry, the poll results. 87% of the audience are going to be reporting their partnership capital accounts on the income tax basis, or partner capital accounts on the income tax basis. That is exactly the answer we were looking for. So thank you, one and all. And with that, I will pass it back off to Cindy to cover some depreciation topics.
Yeah, back to me. Thank you. I'm really excited that they asked me to talk about this particular section. Anybody that works with me knows I love depreciation. I'm talking about it all the time. And so the first thing we're going to talk about is bonus depreciation. Bonus depreciation is a very powerful planning tool because it allows you to expense 100% of qualifying property through the end of 2022. Generally, qualifying property has a useful life of 20 years or less. And if you've been in business a while, you know bonus depreciation's been around a while in many different forms. And in the past, we couldn't use used property for bonus depreciation, but we can now use property that's used as long as it's the first time you're using it in your business. So that's very powerful. Also, that we have another expensing election that's been around a while that people talk about a lot, which is the Section 179 expensing deduction. There are some limits on the deduction. There are some limits on how much you can spend in order to be eligible for the deduction. And the deductions gets completely phased out after you spend $3.6 million. It's also limited to your net income, where bonus depreciation isn't. So a lot of questions I get say, why do we care about Section 179 when there's bonus depreciation? Well, Section 179 can be more flexible than bonus depreciation. Bonus depreciation is kind of an all or nothing. If you place several assets in service in a year that have a 5-year life, then you have to take bonus depreciation on all of them or none of them. And Section 179 lets you pick and choose. There's also some people are required to capitalize portions of their cost of production and in those types and cost of their inventory. And in those types of situations, sometimes Section 179 is better because it's not required to be capitalized, but depreciation is. So this is an area where you need to talk to your tax advisor and talk to them about what you're doing, what your goals are, what else is affecting your tax position, so that you know exactly which type of depreciation that you want to take. And then, of course, there's the regular depreciation if you take neither of those, so you have time. The next thing I want to talk about a little bit about is cost segregation. And I like to talk about, as we're working through every day, formal cost segregation and informal cost segregation. Formal cost segregation is where you build a building and then you hire a consultant to come and look at that building and say, these things qualify as tangible personal property, and these things qualify as a building. These things are part of your building in order to run your equipment. One of our favorite examples here in Southeast New Mexico, where we have a lot of welders, and they'll build a building. Now, a building just needs regular electricity to turn on the lights, but it needs super powerful electricity to turn on their welding machines and things. And so a cost segregation specialist can segregate those out, where you can get a faster life on that depreciation used to turn on the welding machines. So back to the financing and matching up your cash flow with your deductions, a cost segregation can really help you. A formal cost segregation can really help you speed up those deductions to more match your cash flow when your financing is 10 or 15 years and you have to depreciate the building over 40 years. So, and it identifies things that are eligible for bonus in Section 179. What I like to call an informal cost segregation is, this is where you can help your tax advisor. If you build a building and it's not cost effective to do a regular cost segregation, make sure you have gathered all of the invoices, you have talked to your builder, and you've picked out those things that he can help segregate out for you in his invoicing. And if you have a turnkey project, make sure that turnkey project segregates out all the equipment, and you don't miss some of those kinds of deductions when you're putting property into service. So with that, I think we're going to move on to the next section.
Okay, thanks, Cindy. And here we are going to pass it off to Kellie, who's going to give us a quick update on the Paycheck Protection Program.
Thanks, Chris. So the PPP loan is a hot topic right now. The SBA opened the forgiveness app portal on August the 10th. And right now there are 3 forms available for the forgiveness application. The first form, 3508S, is available only if you received a PPP loan for $50,000 or less. So if you're able to use this form, the forgiveness is not reduced for any drop in pay or any drop in head count. And the form does not require a Schedule A to fill out. And it has fewer calculations and less documentation required. But it's only available, like I said, if your loan was $50,000 or less. So the next form, 3508EZ, is for people to use if your loan was more than $50,000, and if you did not have a drop in pay or head count, you can use this form because it doesn't have a Schedule A to fill out. So it's a little easier. And the third option, if you aren't eligible to do the S or the EZ, is just the plain form 3508, which is the full form. It has a Schedule A. You need to do the calculations if you had a drop in head count or a drop in pay during your covered period. So when and if the loan is forgiven, the forgiven amount is not taxable income. And they've also released guidance that lenders are not supposed to issue Form 1099-C for debt relief, because normally if you have a debt forgiven, it is taxable income, but the PPP loan is not. So the biggest item of discussion are expenses that are paid from a PPP loan. The IRS released Notice 2020-32, which said that any expense funded by a forgiven PPP loan is not income tax deductible. After they released this, many people, including the AICPA, people in Congress, said that this notice went against congressional intent when they passed the PPP, that Congress intended for these expenses to be able to be deductible, but so far Congress has yet to pass anything to clarify the intent and to make them deductible. So as of today, we're stuck with Notice 2020-32. So there's a lot of questions right now. Do you deduct the expenses for 2020? if you deduct them now, do you have to amend the tax return later if guidance comes out differently? So what we're thinking is the best course of action right now is to wait. We need additional guidance from the Treasury or the IRS. We need Congress to act and really clarify how to treat these expenses. So unfortunately, if we don't get any guidance soon, this may mean that extending your 2020 return is the best option if we don't have any information released by the initial filing date. And after that quick update, our next polling question is up.
Okay, thanks, Kelly. Next polling question covers that PPP forgiveness application. Is the PPP forgiveness application 3508S, is it for loans that are under 10,000, loans that are over 100,000, loans that are under 50,000, or does this form not really exist? Maybe it's something that Kelly just made up for this presentation. Give everyone a few moments to respond to this polling question. In the meantime, we've had a couple questions that have come in on the PPP and that loan forgiveness. First one that came in, can you clarify what you mean by expenses used with a PPP loan?
Sure. So the PPP loan is forgiven if you spend the money on qualified expenses, the primary one being payroll. So if you receive the PPP loan and then spent that money on payroll, those are the expenses that I'm talking about that are under question if they're deductible or not. So if you got a $50,000 loan and spent it all on payroll, that $50,000 payroll expense is what we're waiting on more guidance to see if it's deductible or not.
Thanks, Kelly. Look at the poll results real quickly. 85% of the audience said that the form 3508S is for loans under 50,000. So that is exactly correct. It's what we're looking for there. So let me go ahead and pass it back off to Cindy now, who is going to quickly cover a couple topics on retirement plans. Yep. Cindy, I think you may still be muted.
Yeah. Hello, everyone. Yes, thank you, Chris. I'm going to talk just to hit the high points on a few retirement plans that are available that you should consider. They're traditional profit sharing plans like your 401k plans. They're really flexible. Employers can make a match. And what employers really like too is your plan can allow for a discretionary employer contribution, a profit sharing contribution in addition to the match. And those are deductible, but they must be made by the extended due date of the tax return. Small employers only really like SEP plans or simplified employee pension plans. Only the employer contributes to those. It can be set up in 2021 for 2020 deductions, and deductible contributions can be made up to the extended due date of the return. No elective contributions are allowed on those. And then if you're in one of those specified trader businesses, I want to encourage you to talk to your tax advisor about a defined benefit plan. You can put a lot more cash back into a defined benefit plan rather than a defined contribution plan like we just discussed. Defined benefit plan is just like it sounds. You can define your future benefit up to the maximum, and then your contributions are determined by what it's going to take to get to that future benefit that you're going to get. Generally, those contributions are required to be made for a certain period of time. And the only real thing that can reduce those contributions is if you can make a case for economic conditions. So please, I encourage you to talk to your tax advisor about retirement plans. I like those types of deductions. when you have the profit to make those. I really like them. And then retirement plan startup costs, if you don't have one, there is a little credit out there of $500 if you qualify. You have to have less than 100 employees. They have to make at least $5,000 in compensation each. At least you have to have at least one non-highly compensated employee, and you can't be contributing to a 401k plan or a SEP plan already and set up a new plan. And so it's about $500 a year and can be claimed for the first 3 years of the plan. So it's a really good deal. And so now I'm going to pass it on to what everybody wants to hear about, is what we know about the 2020 election.
Thanks, Cindy. So there's a lot that we don't know. Like I said, it's been a crazy week. What we do know is what the law is now, and we also know what the candidates' tax plans were, you know, as they promoted them during the election. But with the Senate seat still up in the air, with Georgia heading towards a January runoff, it's hard to know how these specific tax plans will work. I will direct you to the CRI website. We have a great summary of the candidates' plans. I can say that under Biden's plan, there are some changes to tax rates, capital gains rates, potential changes to estate exemption levels, and changes to like-kind exchanges. Those are the big things that could impact taxes, but this is definitely something that we at CRI are closely monitoring and will continue to update all of you with. And with that, I'll turn it back to Chris.
Great. Thanks, Kelly. And that's actually a great segue for my next slide here, which is the reason why you should connect with CRI on social media. Exactly what Kelly just said. We will be staying on top of all the changes that will be forthcoming when the political dust settles and Congress and the new administration gets to work. We will stay on top of any changes, and the easiest way for you to stay on top of those changes is to connect with us on all the major social media platforms. You can always visit us on our website, cricpa.com. You can also text CRI to 66866 so you can receive our news and alerts. And with that, I would like to thank our presenters today, Kellie Shipley and Cindy Bryan. We try to hit on as many topics as we could, and I think Kellie and Cindy both did an excellent job at covering those pertinent details. And also want to thank you, our audience, for spending an hour out of your afternoon with us today to learn more about how your business may be able to do some year-end tax planning. So hopefully you've gotten a few nuggets here that you can think about and reach out to your CRI advisor, and we can help assist in implementing those plans. So with that, I'll say thank you and have a great day.